In October 2025, cocoa farmers across Ivory Coast celebrated what seemed like a historic moment. The government had announced a record farm gate price of 2,800 CFA francs per kilogram, the highest price many growers had ever seen, for millions of families who depend on cocoa fields for their daily survival. It felt like long-awaited recognition of their hard work. But only a few months later, that optimism collapsed. In early 2026, the government was forced to slash the price paid to cocoa growers to just 1,200 CFA francs per kilogram. In a matter of months, farmers lost nearly 60% of their income. The shock spread quickly through rural communities where cocoa is often the only reliable source of money. This sudden reversal raised a deeper question. How could the world's largest cocoa-producing country become so vulnerable to changes in the global market? The answer reveals a much larger story about how Africa participates in the global economy. While Ivory Coast dominates global cocoa production, it still exports most of its cocoa as raw beans, leaving the real profits of chocolate production in factories overseas. At the same time, another West African country is trying a different path. In Burkina Faso, new efforts are emerging to process agricultural products locally, from cotton to tomatoes. It is still early, and the challenges are enormous, but the contrast is forcing many observers to ask an important question about Africa's economic future. In early 2024, the global cocoa market experienced an extraordinary surge. Prices climbed to nearly $12,000 per ton, an unprecedented level that shocked both traders and governments. For Ivory Coast, the world's largest cocoa producer, the boom seemed like a rare opportunity to reward farmers who had spent decades cultivating the crop that fuels the global chocolate industry. Encouraged by the rising market, the government announced a historic farm gate price of 2,800 CFA francs per kilogram in October 2025. The announcement came just before the presidential election and was presented as a commitment to ensure that cocoa farmers benefited from the global boom. Across the country, growers welcomed the decision with excitement. Many believed that after years of volatile prices, stability had finally arrived. Yet, the optimism did not last long. Global cocoa prices began to fall rapidly as markets corrected after the dramatic surge. By early 2026, the international price had dropped to roughly $2,900 per ton. Suddenly, cocoa produced in Ivory Coast was far more expensive than the global market price. Exporters hesitated to buy, shipments slowed, warehouses began to fill with unsold cocoa beans. What had once looked like a moment of prosperity was turning into a serious crisis. Faced with this situation, the government made a painful decision. The farm gate price was reduced to 1,200 CFA francs per kilogram. The cut was dramatic, nearly 60% in just a few months. For farmers, the consequences were immediate and severe. A season that had begun with hope ended with uncertainty, leaving many rural communities struggling to understand how such a sudden collapse had become possible. One of the most striking aspects of the cocoa crisis in Ivory Coast is that the country remains the largest cocoa producer in the world. Yet it captures only a small portion of the wealth generated by the global chocolate industry. Every year, Ivory Coast produces roughly 40% of the world's cocoa supply. Millions of tons of cocoa beans leave the country's ports and travel to factories in Europe and North America. There, the beans are transformed into cocoa butter, cocoa powder, and chocolate products sold across supermarkets around the world. But this global value chain is deeply unequal. While chocolate companies generate billions of dollars in revenue, the farmers who grow the cocoa often earn only a small fraction of the final value of the products made from their crops. A chocolate bar sold for several dollars in a Western supermarket may contain cocoa worth only a few cents to the farmer who cultivated it. This structural imbalance makes cocoa-producing countries extremely vulnerable. When global prices rise, farmers may experience temporary relief, but when prices fall, the consequences are immediate and severe. Because Ivory Coast exports most of its cocoa as raw beans, the country remains heavily dependent on the volatile international market. It does not control the most profitable stages of the industry, such as processing, branding, and retail distribution. In other words, even though Ivory Coast produces the raw ingredient that powers the global chocolate market, it does not control the chain of value that determines the real profits. This reality explains why a sudden drop in international cocoa prices can trigger such a dramatic crisis inside the country. Without strong domestic processing industries, the national economy remains tied to forces far beyond the control of its farmers. For the millions of farmers who grow cocoa in Ivory Coast, the price collapse is not just an economic statistic. It is a shock that directly affects daily life in rural communities. Around 5 million people in the country depend on cocoa for their livelihoods. Entire villages are built around the rhythm of the cocoa harvest. Families invest months of labor preparing the soil, maintaining trees, protecting crops from disease, and harvesting the pods by hand. When the government announced the record price of 2,800 CFA francs per kilogram in late 2025, many farmers believed their financial situation might finally improve. Some invested in fertilizers or hired additional labor to increase production. Others hoped to repair homes, send their children to school, or pay long-standing debts. The sudden price reduction to 1,200 CFA francs per kilogram therefore felt devastating. For many farmers, the income from an entire season was cut, almost in half overnight. Yet the costs of production did not fall. Fertilizers, tools, transportation, and labor still had to be paid. In some areas, farmers reported that the new price barely covered the basic expenses required to maintain their plantations. The psychological impact has also been significant. Growers who once believed that cocoa could provide stability now feel uncertain about the future of their work. This situation illustrates a deeper problem within commodity-dependent economies. When a country relies heavily on a single export crop, fluctuations in global prices can quickly translate into social stress at the local level. For Ivory Coast, the cocoa crisis is therefore not only a question of markets, it is also a question of livelihoods, stability, and the long-term future of rural communities. While Ivory Coast struggles with the consequences of volatile cocoa prices, another West African country has begun experimenting with a different strategy. Burkina Faso, though far less wealthy and facing serious security challenges, has started to place greater emphasis on processing its agricultural products locally. The idea behind this strategy is simple but powerful. Instead of exporting raw agricultural materials and allowing foreign industries to capture most of the value, the country is trying to develop domestic industries that transform those materials into finished or semi-processed products. One example often mentioned is the development of tomato processing facilities. In recent years, Burkina Faso has supported the creation of local plants capable of turning fresh tomatoes into paste and other products that can be sold within the country and across the region. By processing the harvest locally, farmers can reduce losses after harvest and potentially earn more stable incomes. Another sector receiving attention is cotton. Burkina Faso has long been one of West Africa's important cotton producers. Traditionally, Most of this cotton has been exported as raw fiber. However, new discussions have focused on expanding textile and garment production so that more of the value chain remains inside the country. The political leadership of Captain Ibrahim Traore has frequently emphasized the importance of economic self-reliance and national production. Supporters argue that Africa must move beyond the historical pattern of exporting raw resources while importing finished goods at higher prices. Of course, the transition toward domestic processing is not simple. Building factories requires investment, infrastructure, energy, and skilled workers. But the underlying idea reflects a growing belief that the long-term future of African agriculture depends not only on producing crops, but also on controlling what happens to those crops after they leave the farm. The contrast between Ivory Coast and Burkina Faso has sparked a wider debate about development strategies across Africa. Both countries rely heavily on agriculture, yet they are responding to global economic pressures in very different ways. Ivory Coast has built a powerful agricultural export machine. It produces more cocoa than any other country in the world and has developed a sophisticated system to organize farmers, manage exports, and stabilize prices. This system has helped the country become a central pillar of the global chocolate industry. However, the recent price collapse has exposed an important weakness. By focusing mainly on exporting raw cocoa beans, the country remains highly vulnerable to fluctuations in the international market. When global prices fall, the effects are transmitted directly to farmers and rural communities. Burkina Faso, on the other hand, is trying to experiment with a model that focuses more on local transformation. Instead of relying entirely on the export of raw commodities, policymakers have begun to encourage processing industries that can add value inside the country. This approach has also generated debate internationally. Some critics in Western media question whether Burkina Faso has the political stability, infrastructure, or investment environment needed to sustain such industrial ambitions. Others argue that the projects being promoted are still too small to transform the national economy. Supporters respond with a different perspective. They argue that Africa cannot escape commodity dependency unless it begins building its own industries step by step. Even small factories, they say, represent the first stages of a long process of economic transformation. In this sense, the debate is not simply about one country or another. It is about a larger question facing many African nations today. Should they continue to rely primarily on exporting raw materials, or should they invest more aggressively in industries that keep value and jobs within their own borders? The crisis in the cocoa sector offers an important lesson not only for Ivory Coast, but for many African countries whose economies depend heavily on raw commodity exports. When global markets rise, these countries may enjoy short periods of prosperity, but when prices fall, the same dependence can quickly expose millions of people to economic uncertainty. Ivory Coast remains a giant of global cocoa production. Yet the recent price collapse has revealed how fragile that success can be when most of the value chain lies outside the country. Farmers produce the beans that feed the global chocolate industry, but the greater share of profits is still generated in foreign factories and international brands. Across the continent, this reality has sparked renewed conversations about economic transformation. Many policymakers and thinkers now argue that Africa must move beyond the historical pattern of exporting raw materials while importing finished products at much higher prices. This is where ideas associated with Pan-African economic cooperation are gaining attention again. The concept behind Pan-Africanism is not only political unity, but also economic collaboration that allows African countries to strengthen their industries and retain more value from their natural resources. In countries like Burkina Faso, Leaders such as Captain Ibrahim Traore have repeatedly emphasized the importance of building domestic industries that process local resources. Supporters see these initiatives as part of a broader vision, sometimes described as an Africa New Moment, in which African nations seek greater control over their economic destiny. The African Union has also promoted strategies encouraging value addition, regional trade, and stronger agricultural industries across the continent. Whether these ambitions succeed will depend on investment, stability, and long-term planning, but the debate itself signals an important shift. The cocoa crisis in Ivory Coast has reminded many observers that producing raw resources is not enough. The real question for the future is whether Africa can transform its vast agricultural potential into industries that benefit its own people. The answer to that question will shape the next chapter of economic development across the continent.